life, your term show.
All right, Hanif. So you've joined us. I appreciate you taking the time. I know you have a ton on the go. So maybe just to give everyone some context, just kind of like a little synopsis of kind of, you put a lot of different real estate data. I think you have your hands in a lot of different stuff. You're always looking at different angles. To give everyone some context, I guess maybe where your perspective's coming from, can you give everyone just a bit of understanding of kind of what you do on a kind of full-time basis there, all the stuff you buy?
Sure. So we are running a platform, WOWA.ca, WOWA.ca. So it's one of the most popular personal finance platform in Canada. Every month we have close to 500,000 unique users. So if you assume that the population of Canada is 40 million, that means every single month, 1% of Canadians coming to our website seeking to know financial knowledge and know their options, because unfortunately, many people don't know how many options they have when it comes to financial decisions. So what we are trying to do to let them know that, okay, this is data, these are the options, and we try to make things simpler. For example, when it comes to real estate, our housing markets are the most popular in Canada. If people search like Toronto home prices, we typically have number one or second in the Google. We try to make it simpler for the people that what is happened and like they can analyze and what are the options they have for different financial decisions, from real estate, trading, getting credit card to getting personal loans. All of that is on taxes.
Yeah, insurance too. Is insurance up there as well?
Insurance too, but we haven't been that successful in that domain.
Gotcha.
So we have pages, but they're not that super successful. Our main successful pages are in mortgage, in real estate.
Gotcha. Yeah, I think you were coming up for a bunch of stuff. I was recently looking for some cross-border credit cards for a different company we're setting up, and you were coming up for some of that type of stuff as well that I saw. So, and you put out a ton of good stats about the banks, which are interesting, and the mortgages in Canada, especially the last couple of years. A lot of people were expecting some real kind of bad things to be happening right around now because of the number of mortgage renewals that were coming out, and you were kind of tracking those numbers and stuff too. So it's helpful that way. For today, just because of the interest of time, recently I think you've put out a couple things that kind of caught our attention around, I guess, kind of the wealth inequality in Canada, or that's the way you're referring to it as well. And can you kind of maybe explain that for everyone, what you've looked at? Because I think you've been looking at kind of, I don't even know where to start with this, because there's the hard money aspect. Okay, so let's go back. Let's take a step back. What was the recent thing that you put out? The best performing asset in Canada. What was the time frame that you went back to? Was it the year 2000?
From 2000, like the article that I wrote for Global Mail, I think. I found it. I think it was published July 17. So in that article, we compared different asset classes, and surprisingly, even for myself, gold was the winner, even over S&P 500 in the US, because I was expecting that the winner be S&P 500, and of course we didn't consider Bitcoin there. So we consider traditional assets that has been around from year 2000, and the winner has been from 2000 was the gold, which actually has, and I'm looking at the data, it has 1,000% growth in 24 and a half years. And after that one is typically, most of the time, is S&P 500, but also could be real estate if it's the rental yield can reach to 4%. Because for real estate, some of the mistakes that people are doing is that when it comes to return, they just assume that, okay, the home prices, but the reality is that either if you're living, you're not paying rent, or if you're giving rent, it means that you're having income. So at the end of the day, when you want to calculate the return of a real estate, is the return of the home price plus the rental yield. So we consider three scenarios: one with no rental yield, if it's like cottage, for example, or is 2% and 4%. So at the end of the day, if you look 25 years, 24 and a half years, because it's the 2001, I didn't know that. I thought that the 21st century. I started in 2000, but then I noticed that no, it's just 2001. But anyway, so when I look at that, when it's 24 and a half years, gold has performed better than anyone with 1,000%. And after that, when we look at the other things, is like home price. If someone has a rental properties that has like giving continuously 4% net yield, is 653%, and after that was S&P 500 with 565%, and then other things like S&P, like TSX in Canada, or if the rental yield is around 2%. But if you go to 10 years, the story would be a bit different, because in 25 years we have the financial crisis of 2007 and 8, which corrected the stocks market there. But when we look at like 10 years, actually the best performing one would be S&P 500, but again, not far from gold. Again, this second one is gold, not much different. And the reality is that when you look at all of this, one thing is very clear, that the assets are going up because the money supply is going up, because the value of the money is going down. So when the problem is that, like when it comes to inflation, people know or hear in media of one number, CPI. Okay, inflation is 2%, 3%.
2%. Yeah, exactly.
But your devaluation of the money is much faster than that. So that's a trick, kind of, to be honest, like by I don't know, maybe politician or whatever that.
Well, sorry to interrupt. I think what happens is they can, with their CPI, the basket, the way the Canada does the goods, is they can use a replacement method. Whereas if something gets too expensive, they can then take something. So the example that Tom and I always use, we're like, well, look, if they were using steaks back in the day, like a ribeye steak in the CPI, no longer is a ribeye steak. It might be ground meat at the best. You know, maybe it turns to hot dogs eventually. I don't know, but you're not, and it's not the same quality. So they'll just substitute things to kind of fluctuate that number a little bit. And then sometimes what happens, sorry, I'll cut you off. So that's the way we look at it with that, right?
That's true. But the main thing is that when it comes to CPI, we are talking of consumer product, okay? Means meat, chicken, milk, those stuff, okay? There are two tricks there. One is what you said. Something become more expensive or become larger is go out of the basket automatically. You know, something that maybe was high quality before that people were consuming. If they consume now, it's like much less than before, it goes out of that like basket. But one main aspect is that CPI is not reflecting the devaluation of the money. Why? Because the technology aspect, you know, now the amount of like considering lots of the thing happened, the chicken now is much cheaper, like in reality, to grow, like compared to 50 years ago, because of lots of genetic things and other things, or feeding process or mechanism that they apply. But my point is that the technology always is helping to decrease the cost of the thing. So that kind of canceling kind of some part of the devaluation of the money. When you look at the devaluation of the money, CPI is not the best metric, in my opinion. Is that actually look at the hard asset like gold, or the gold itself, because it is a limited supply that is 1 or 2% is increasing in the world, is one of the best metric that you can see that, okay, what's happening? What is happening is that like the money supply, which is a complex definition, I don't want to go over here, but it's kind of money that's circulating in economy every year is almost increasing by 7% since 2000, 7.5% actually in the last 25 years. So it means actually the devaluation of the money is around like 7.5%, not 2% CPI that you are hearing in the middle. That 2% is a basket of that you consume, you know, that it can change. If it becomes something expensive, you will not consume that one. So it's simple, okay? Or if the internet is become cheaper, it's because of technology. You know, or if the cell phone is becoming cheaper, it's because of technology. It's not because that means it kind of canceling out devaluation of the money. At the end of the day, your money is kind of losing its value.
It buys less,
every single year.
6 years ago, I joined the Rockstar Inner Circle with zero real estate experience. I just knew I wanted more control over my life, and I had no clue where to start. What I didn't expect was how much more this community would give me. I've learned how to invest, how the money system works, how to build real assets, and most importantly, how to shift my mindset. This group helped me launch a business, grow my real estate portfolio, and make smarter financial decisions with confidence. But it's not just about money. It's about freedom and surrounding yourself with people who actually get it. And here's the best part. You can try the full Rockstar Inner Circle experience today for just $9. That's right, everything. One-on-one coaching, training, live events, and access to the entire Rockstar community. The Rockstar Inner Circle positively transformed how I think about money, investing, and life. And it all started with just one decision. Go to rockstarinnercircle.com/just $9 and jump in. You've got nothing to lose and everything to gain. That's the word just, the number 9, and the word dollars. No spaces. Again, rockstarinnercircle.com/just $9. Now back to the show.
Yeah, so first I got to ask you, when you speak to people in the mortgage and real estate world, because in our world where we speak to people in those worlds, very few people are talking like this. Do you have these, like, are people looking at you like, Hanif, like you're out of your mind? What are you even talking about? Like mortgage, you know what I mean? Like what kind of, I'm just curious, like, is your line of thinking from the people that you communicate with most in those worlds, is it an outsider line of thinking? Because in our opinion, it is.
It's very simple, like, because we don't have any concept of asset inflation. Mm-hmm. People are not economists, like people are hearing news and everything. They think that, okay, is inflation? Inflation is 2-3%. That's not real inflation. It's a basket that they made a put coefficient over it, and they call that one CPI, and that change in 1 year is 2%. I always give that example because always they say that, oh, inflation. This is not inflation. Like homes goes up, okay? Shelter is a big part of CPI. But when it comes to shelter, it's mostly rent. And when it comes to mortgage payment, if the home price goes up, the older people who were paying mortgages, their payment would not increase. The new home buyers, their payment will increase. And that is like a small segment of the market.
Yeah, so it doesn't impact everyone.
When the home price goes up, it shows itself not much in the CPI. And that's a kind of, I'm not saying it's a trick, but it's a good metric, but it's kind of misleading.
It's not spoken about. It's just not spoken about. And it's something that kind of blows our minds a lot. Have you ever read the book, The Price of Tomorrow by Jeff Booth, or no?
No.
Oh, it's a great book. Canadian author, great guy. And his book was the first one that got me, that when it finally clicked for me and I was understanding the technology point that you just mentioned, he's like, not only is it inflation, he goes, technology should be getting better. So he used oil as an example. He goes, look at oil. The oil price keeps going up. He goes, the technology for us is so much better to extract oil from the ground. It's so much easier for us, but we need to keep pumping money into the economy because we need the price of these things to go up. And we don't have to get to the details of that now. But something else that we looked at, so to your 7% number, just over 7% of M2, we looked at that as well. And then we put it against not Canadian real estate, we put it against Toronto real estate prices from 1969 for the average price on the Toronto Real Estate Board. I guess you've done that as well. Because
we have done something to compare the value of the home in the Canada compared to gold. If you look at it, like actually it was, if I can find it.
Because when we looked at the TREB, so while you look for that, when we looked at the TREB number was like, it's just under 7% of the average sale price. And then the money supply was about 7%. And we're like, that's really interesting. It just lines up. It lines up almost too well. And we're going back decades, right?
Exactly. So the point is that, like, if I want to tell the story of the wealth gap, is that what is happening in reality is that, like, if you have assets, your asset grow, whatever asset you have, sooner or later, it will grow with close to money supply. So either you have stocks, I mean an index, if you have index, or silver or gold or Bitcoin. Okay, Bitcoin is not beating, but I mean, all of these things that has a kind of limited supply or has some limitation in it, all of them are growing like between, I don't know, 5 to 10% per year. But in reality, what happens, the wages of the people are increasing typically with CPI, maybe 2-3% per year. So then what is happening is that the people who are relying on the asset become richer and richer. The people who are relying on income, actually they feel that their power of buying is going down. It's natural. Like that's like what see here in the home unaffordability in Canada is not okay. It's a surprise because when we see it is more unaffordable compared to, like, for example, US. But generally speaking, home price in 10 years typically goes up, not because of, it's very simple, because of the money supply. But the money supply goes up, money should go somewhere. This money should go somewhere, either go to the housing, goes to the gold, goes to the stock. So it's increase their prices. And the funny thing is that, because when it comes to wealth inequality, government's solution is typically is that, increase the income tax. But income tax is for the people who are working. And is it funny because actually the wealth gap is coming from assets, not from incomes, and the incomes are not going up that fast that you just try to increase the tax on it. So what is happening is that the people, especially the working class that rely on their income and they don't have much asset, they become relatively poorer. Okay, maybe what they're eating is the same as 10 years ago, but that itself is a bad thing because of technology, everything should improve. You know what I mean? So What is happening is that because their income's going up with more and less with the inflation, CPI, okay? But in reality, the money supply is growing much faster. So whoever has any assets, the assets are going up, so their purchasing power going up. So at the end of the day, so wealth gap increase because of the actual monetary policy that is running by the government.
And to me, to us, the way we look at it and the way we call it, and maybe it's a little bit, extreme, but it kind of doesn't really feel extreme anymore. We look at that as the destruction of the middle class in Canada.
Exactly.
And it's what's happening. And people are like, well, I don't understand. Like, why are they creating this money? But when we spend money poorly and we make poor decisions with our money, and we have to increase the money supply, so borrow more money because the government, and I'm just going to say it, the amount of waste in the government is excessive. No one can argue with that. That's not a political statement. It's not left, right, middle, anything like that. I don't care what party you support or what side of anything you're on. It's excessive, the amount of government waste. And that's really robbing us all. So anything that they're doing, that's kind of, this is the problem I feel that people aren't talking about. And I just don't understand, why. And then even investors, when investors look, like, if you strip out the money supply, the growth. So if you strip out the 7%, most people, we really aren't earning that much of a return. Like, if you pick a one-off stock that does very well, but if you're in an index fund, like you suggested, real estate's no different. Like, real estate, unleveraged real estate doesn't work. If you can use leverage real estate smartly. So if you do, 80% loan to value, so call it a 5-to-1 ratio, and you earn 7% on your real estate, maybe, let's say it's breaking even, it's paying for repairs from the cash flow component. Well, then because of the 5-to-1 ratio, that 7% all of a sudden turns into
much bigger. So because of the leverage factor, actually real estate is winner over gold. If like we did a concept, we assume that the people pay by cash, but no one does that.
No, of course.
Factor. You never do that with the gold, because even the gold ETF is leverage factor. If I don't want to go over it, but leverage ETFs losing money because of volatility. So at the end of the day, the only assets that people can go with a leverage factor of like 5 or 4 is real estate. So at the end of the day, if you look at how much money you put and how much you return, real estate in the last 10 years or 25 has always been.
Yeah. To me, it's and it's going to be leveraged. And we have some properties, to be honest, is that we've paid down quite a bit. The mortgage on them is tiny. I've had them for 20 years. We've just kind of never refinanced them. And I'm looking at them like, so the return on that real estate really isn't that good. Like, it's been good. It's treated me very well over a couple decades owning the properties. I'm not complaining, but as we got to understand this point, I'm like, so my overall return is just it goes lower and lower as I don't have this leverage, because this money supply thing, like, I'm not actually earning that most of that run up in prices, and it never goes in a straight line. And I think that's where some people get confused, is that they're like, well, like real estate's down right now, or gold had many years that things go down, but that's everything's cyclical. It'll overshoot, like gold will overshoot and then come back down. Real estate overshoots, comes back down, goes too low, goes back up, like everything. But it comes back to, the way I look at it, similar to what you said, is that, in a 10-year time frame, it's almost like as an investor now, you can't just make your investment decision based on the type of property, area of the property, and the income it brings in. You also have to decide for yourself, do you think that the money supply is going to grow over the next 10 years or not? And
at least at this point of, I should say that, like at this point of economy, like maybe the growth becomes 6% or 5%, but the growth will be there in long term. You know what I mean? So the real estate or any other asset, because for example, some people ask me about Bitcoin, and I don't have any expertise in Bitcoin, but what I can tell you that is that because of the increase in the money supply, this thing will go up, because you have a 7% increase in the money supply, it should go somewhere. Okay, so more or less every asset will get some of that capital, and it will go up.
Could you imagine we took that 7% every year and we invested it into our country, into infrastructure to make Canada stronger? And could you imagine we did that? Like, just think how much better we'd be than because it has to go somewhere, like you said. So it just goes to these assets because people are just trying to protect themselves. And then some people, last thing, because some people will look at investors and they're like, well, the investors are the problem with the housing market. And I'm like, well, hold on. If someone understands this in the system and they're just trying to protect their families and the future for their children because they're trying to protect their savings, can you really blame them? But sorry, I cut you off. I think you were going to say something.
Actually, you made a very good point. So this money supply is increasing, and it's not increasing by people. Is increasing by a system that mostly is actually government and federal banks policies, from quantitative easing to decreasing interest rate, and also the one of the big one is continuous deficit of the government. So at the end of the day, so it's natural for ordinary people to try to protect themselves against this devaluation of the money, and so it's natural for them to invest. So then the question is that so then whom should we blame for a speculative investment in real estate? Actually, the one that should be blamed is government policies. First is increasing the money supply. Second is that how is their responsibility to incentivize people to invest in ventures. And it's not that hard that people think. Like the capital gain tax in Canada is for if someone start ventures, I don't know, it's like one, the exemption is 1,200,000 something is very small, consider the risk that it comes. In the US, they have it with $10 million USD. So it's very natural. If I want to the money go somewhere, I should make it more appealing. Okay, so if you think that too much money goes to real estate, okay, so you should make the ventures appealing. How to do that? Just incentivizing tax. You said that, okay, no capital gain tax until $10 million for a small businesses. So then the people think that, okay, maybe I can invest in that business. You know what I mean? But when you don't do that, it's natural that people think that, okay, the real estate is safer, and the money goes there. Another aspect is the lending aspect. The banks is kind of in Canada somehow it's extension of the government, from the point that because there are not much competition, So, and when 50% of the loans that they are giving, except is residential real estate, it's natural that, okay, money goes to real estate. If they were giving more loans to, for example, to venture and small businesses, so this money supply increase could make those things that you said, make infrastructure, make jobs. But the point is that governments are very, the banks are very conservative in Canada. You can look at the portfolio of the banks in the US, it's not like that. So the 50% of everything for them is this residential real estate loan, that even also CMHC come and help them to decrease the risk for them. So it's natural for them. They typically give loans to this real estate or very large corporation that typically protected by government,
Yeah.
this lack of competition. So at the end, if you want to have a prosperous country, it happens if the small businesses can go up, means we have more small and small ventures, and they have a chance to go up. How they do that? For doing that, we should give them like more capital gain exemption for these small businesses, and also incentivize bank to give loan to these like small businesses, and also not protect the large players all the time. Because if the all large players always be protected, the small businesses, how can I? Someone wants to grow, someone else should come down, you know?
Yeah, and that's how the bank, and they do it with the banks, and that's why the banks keep going to residential real estate, because it's easy for them. Like you said, the government will insure those mortgages, they can get them off their books, it allows them to keep lending and keep earning. So then it removes competition. Yeah. It's like,
because below 20% is CMS insured. So no, and more than like if the LTV is like, for example, is 80 or is 80 or less. Okay, if what could happen? Like the real estate even drop like 20% in a year. Typically, it doesn't happen. Like typically, real estate is safer. So the thing is that banks are kind of safe, and people don't in Canada even like people don't track it, but people in Canada, they miss mortgage as a last thing. They may miss many things. They may start not going travels or buying the same thing. The last thing they do is missing their mortgage because of the bankruptcy rules that we have here that is different than the US. Like if you look at, like, for example, the bank's report last quarter, even that you see that ACL, PCL, and write-off went up. When you look at details, you see that the mortgage is kind of very small write-offs.
So then why do the write-offs go up? Is it credit card debt and like auto loans and stuff? Like what are the write-offs coming from if the mortgages are still such a small? Because I've seen that the default ratio on the mortgage is still like a fraction of a percent, right?
It's very small. So it's coming from personal loans, from credit cards, from auto loans, from other, but that's a start, you know, like if those one continue, it can reach here too. But my point is that the banks are focusing on something very safe, that is residential real estate. And at the same time, the loans and the money supply increase doesn't go and feed other part of the economy that like small ventures.
I got to ask you, Hanif, because I know we're running out of time. What made you get into what made you start looking at the money supply versus the asset prices? Like, I'm just curious because not a lot of people start to go down that path. And do you remember what it was that made you be like, I wonder how that supply, how that's impacting thing, how M2 is?
So you're asking me that when was the first time I was thinking that?
Yeah, like what triggered it in your head to be like, let me go look, and then go look at the numbers?
Oh, okay. Okay, to be honest, it's a bit personal experience. Like when the COVID happened, you know what I mean? You know that in a stock market, you can be long and short, you know what I mean? So at that time I had a portfolio and I thought, okay, because of this, for example, these hotels and other things should go down. Natural, you know, natural is a natural thing. People cannot travel, so their stock should go down and other things. I'm not sure, or for example, even ride sharing things. But so I did buy some put options on some of these stocks and I lost all that money.
Yeah.
Because that time I didn't know that the growth of these things, many of these stocks, is not mainly because of underlying performance of them, it's the money that goes in. So the governments start printing money significantly during COVID. Like you know that, like, you know, if you look at any graph, you see that the M2 is just jumping.
It went straight up, yeah.
And all those stocks that I was thinking that because of lack of revenue should suffer, actually their value increased significantly. That was a hard lesson I learned. Okay, what I made mistake. These stocks, their earning went down. Why their stocks went up? Then I noticed that because there is something that is override every other rules. When in economy, the money supply goes up, the money should go somewhere. So when it goes to the stocks, it increases the value. If it goes to Bitcoin, it increases the value. If it goes to homes. So the main thing is that we maybe control this increase in money supply and also kind of engineering. Like in the US, like lots of this money, like capital increase, goes to the ventures. And you see the results. Like you see that how many new companies are every day, are being born in the US.
Yeah, so you see the difference between the capital allocation there versus here, because
Exactly.
the banks are structured differently too, and there's more incentive for them to do it because there's more upside left on the table because of their tax rules.
It's more competition. Means like if there is competition, people go and try to give loan to anyone because they want competition. But when you are so safe that you have this fat portfolio of like residential loans, it's natural that, okay, why should I go and do risk and give loans to this small venture?
Yeah, it's weird. And like you said, and I know you got to go. And like you said, it's very obvious, at least to me and on my belief, and it sounds like you agree, that this is contributing to a real problem within our society where we're creating more haves and some haves and far more have-nots because the asset owners finish further ahead because of the way the inflation gets pumped into the assets, and the people that just have incomes and they're working on the incomes no matter how hard they work, it's especially the last number of years, it's been virtually impossible for them to get ahead because their savings are getting devalued at such a fast pace. And if you look at, because we're looking at compound annual growth rates of 7% from the inflation standpoint, if you remove the purchasing power 7% a year on someone's savings of $10, $20, $100,000, man, that disappears real quick for people that are retirees or people that are like pensioners, like they're not in a good situation, or anyone else with just savings trying to get themselves further ahead. They can't, and they feel like they're running on a treadmill, and then it leads to other problems. It leads to other problems in society, right?
And the funny thing is that because these are being caused by a system, monetary system, that is the government is behind it. So they cause the problem. And always they want to bring the solution. But it's a bit strange because you made the problem also. If you control your deficit, we have a much better situation. And as I said, typically they come and say, oh, the greed is a problem. The greed or other thing is the natural thing. It's natural desire of people that move their money to somewhere that have a return. It's your responsibility to not manipulate the system too much, that the money goes somewhere like ventures that move the economy. You know what I mean?
Yeah. Look, we'll wrap here. We'll keep this one short. Next time we'll try if we can get you a little bit longer. So I appreciate you jumping on. And the reason, Hanif, is just because, again, I'll say it again, is like you're I want to say one of the first, if not maybe the first person that I've heard just really openly talking about this as part of maybe the issues around real estate, because everyone else is looking at just supply and demand. And I'm not saying supply and demand don't play a part. They play a part in free markets everywhere, the cost of all sorts of goods. But the money supply is equally, if not more important. And it's something that's just glossed over and not spoken about. And it's mind-blowing to me. So I appreciate what you're doing, trying to bring it to the forefront.
So just I add that when I wrote another piece for Global Men, most probably you saw that the trajectory of unaffordability in Canada is started diverged from the US. It's actually 2007 and 8, because that time we decreased interest rate to close to zero, and it lasted for 10 years. But economy was fine. It was not like the US that needed such a big stimulus. So the thing is that when you say supply and demand, actually you're right. But the point is that demand is part of it is a speculative demand. So when you make the money cheap, that money supply goes up, you increase the speculative demand that naturally increases. So demand is not all real. Just I give you one example and maybe finish. If assume that there's a home in this street, okay, and one first-time home buyer wants to buy it, okay, so there's one supply and one maybe one or two, for example, first-time home buyer that are competing with that one. But if suddenly 3 other people who want to invest and rent it out, so then it becomes 5. Demand went up, so the price goes up, but the real demand hasn't changed, because if they get this home, then maybe they should rent it out to those first-time home buyer at them. Mm-hmm. So by increasing the money supply, you're increasing the speculative demand. And the same also comes with the supply. They always say lack of supply, but supply is a very interesting story, because anyway, is maybe for another talk, because that's. But I mean that the speculative demand is part of this.
Yeah, and the kind of supply as well is another point too. That's a big point. Hey, for anyone that's looking we got to do, there's a lot, we've rushed it, and there's a lot of untouched things that we have to touch on. So we have to circle back. But for people that are looking for this type of stuff that you put out, is because I see a lot of your stuff on X. And I think that's the first time I said X without saying Twitter first. So it's taken me a couple of years when I got there. So, but I guess, do you put those types of charts and those reports out on WOWA.ca as well? So people can just go to the website
we have
there?
A page that we allocate for infographics that we put there. Our goal is that, in one picture, people see the whole story. So that's the whole thing. And whatever we post in X or on LinkedIn, we also put it on our website, maybe with a delay of a few weeks. So people can see the plots, and honestly, I think it will help them to understand what is happening, because I have seen many smart people, educated people that honestly, they don't know how the economy works. Very simple, that how this system is working. Yeah.
That's great, man. I think it's a service what you're doing, not just the M2 stuff, which I definitely agree with, but just the insight into it's interesting to see banks' balance sheets, the types of mortgages they're looking at, when the renewals were coming up. It gives people, instead of just reading some sort of clickbait headline and not, believing that, even though the numbers are very different, you just get a quick insight into what's actually going on. So you and your team do a great job with that. So thank you
very much for having me.
And on X, what's your handle on X? Anyone wants to jump on and follow you there?
It's Hanif Bayat. It's just the same.
Yeah. Perfect.
My name, first name and last.
Thanks, Hanif. I appreciate taking the time today, man. We'll talk to you soon.
Thanks for having me.